Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about P3 Health Partners Inc. Annual Report. P3 Health Partners Inc. offers a range of businesses and services that cater to patient-centered care. At its core, the company provides superior care services through its network of clinics and wellness centers across the United States. These facilities serve as hubs for delivering high-quality healthcare to patients in need. The company's focus on population health management enables it to provide comprehensive care services that address the unique needs of each patient. By operating clinics and wellness centers, P3 Health Partners Inc. is able to offer a variety of services under one roof, making it easier for patients to access the care they require. P3 Health Partners Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $2 billion. P3 Health Partners Inc. trades at a lower price-to-book ratio of -0.49 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 81% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through a review of various financial metrics. On the one hand, incurred claims have been a significant driver of revenue decline, with a decrease from $1,339,443,000 in 2023 to $1,317,109,000 in 2024. Additionally, paid claims have also seen a slight increase, but not enough to offset the decline in incurred claims. On the other hand, investment in P3000 LLC has shown significant growth, increasing from $32,438,000 in 2023 to $38,157,000 in 2024. Furthermore, net operating loss carryforwards have also increased, rising from $33,087,000 in 2023 to $51,647,000 in 2024. Other factors that have contributed to revenue growth include the Florida asset sale, which has generated additional revenue, and the increase in fees from management services agreements, MSAs. Additionally, the growth of variable interest entities, VIEs, revenue and deficit funding agreements advances and interest have also positively impacted revenue. However, the decline in capitated revenue from Atrio Health Plans has been a significant driver of revenue decline. In conclusion, while incurred claims have been a major driver of revenue decline, investment in P3000 LLC and net operating loss carryforwards have contributed to revenue growth. The impact of various other factors such as the Florida asset sale, VIEs revenue growth, MSAs fees, deficit funding agreements advances and interest, and equity-classified warrants issuances to VGS entities has also been significant. The financial performance of the company underwent significant changes between 2024 and 2025. Initially, the company incurred substantial losses, with a net loss of $310,378 in 2024. However, this trend reversed in 2025, as the company reported a net income of $123.4 million. This marked a notable shift from operating at a deficit to generating profits. The improvement in financial performance can be attributed to various factors, although specific details are not provided. Nevertheless, it is clear that the company's efforts led to a significant turnaround, resulting in a substantial increase in net income. The company's financial performance has shown a significant improvement in its operating cash flow. In 2024, the company reported an operating loss of $21,958. However, in 2025, this trend reversed with the company generating a positive operating cash flow of $58,291. This shift is a positive indicator for the company's financial health and suggests that it has been able to manage its expenses more effectively or increase revenue. The improvement in operating cash flow is likely to have a positive impact on the company's overall financial performance and provide a stable foundation for future growth. The company's debt level and interest expenses have undergone some changes over the past year. According to the extracted summaries, the ending debt balance decreased from $10,185,000 in 2023 to $2,356,000 in 2024, indicating a reduction in debt. However, long-term debt has increased by $77.9 million, which may seem contradictory. Upon closer examination, it appears that the decrease in ending debt balance is likely due to the repayment of short-term debts, while the increase in long-term debt suggests that the company has taken on more liabilities with longer maturities. As for interest expenses, there was a significant increase of $21,657,000, which could be attributed to the higher level of long-term debt. Overall, it is difficult to determine whether the company's debt level or interest expenses have changed significantly due to the mixed signals from the extracted summaries. Management's discussion highlights several key aspects of the company's strategy. Firstly, the company has entered into related party financing transactions with VBC Growth SPV entities to provide funding to P3 LLC. This suggests a focus on securing necessary resources to drive growth. In terms of tax obligations, the company is taxed as a corporation and pays corporate federal, state, and local taxes on income allocated from P3 LLC. This indicates that management is aware of and compliant with relevant tax regulations. Furthermore, the company has established partnerships with Alzheimer and Atrio through master services agreements and full risk capitation agreements, respectively. These arrangements enable the company to provide support services and perform delegated tasks for its members, underscoring a focus on delivering value-added services to customers. Overall, management's discussion suggests that the company is prioritizing strategic partnerships, securing necessary funding, and ensuring tax compliance as it navigates its growth trajectory. The company's financial policies have been scrutinized through various reports. One key aspect that stands out is the absence of dividend payments to shareholders. According to official records, the company has not declared dividends on its common stock. This decision may be driven by a variety of factors, including a desire to conserve cash or prioritize other investment opportunities. In terms of share buybacks, there is no information available in any of the reviewed pages. This lack of data suggests that the company has not engaged in significant share repurchase activities. The implications of this policy choice are multifaceted and may be influenced by the company's financial goals and market conditions. That concludes the financial summary for P3 Health Partners Inc. Feel free to comment below, and I will be happy to answer them when possible.